This is not financial advice. I'm recording my thoughts about CrowdStrike. CrowdStrike is an industry leader in the cybersecurity space. Its stock is down about 12% after they have reported their recent earnings, and it is currently trading at about $142. If you follow me, you know that my cost basis is about $122, and today in the morning I put a stop loss order for $150 and it got executed. Now the question is whether to re-enter this stock at $141 or not. For that, we'll first look at the earnings, then the forward guidance, and then finally we'll do the valuation based on which we'll take a decision whether to buy the stock at this price or not. In the most recent quarter, they made about $692 million of revenue, which represents 42% year-on-year growth. Their operating loss is about $19.5 million, so they are getting close to profitability. They did maintain 75% gross margin, which is impressive, and the outstanding shares increased from 231 million a year ago to about 240 million today. The balance sheet is great. They have close to $3 billion of cash and cash equivalents, so this company is almost close to profitability, so there's no worry that this company will go bankrupt anytime soon. One worry is the stock-based compensation. In the most recent quarter, they offered about $131 million of stock-based compensation, and when compared to its revenue, it's about 18% of the revenue. Offering this magnitude of stock-based compensation is concerning, but we'll consider that in the valuation. When you look at the forward guidance, they're saying they can make about $3 billion of revenue. But last year, they made about $2.24 billion of revenue. So that only represents 34% year-on-year growth. This is a growth company, right? So the growth definitely is decelerating, but we'll consider that in the valuation. In the valuation, I'm going to give two cases as usual, one with reasonable assumptions and the other with great execution. In the reasonable valuation, in 2022, they made about $2.24 billion of revenue. I'm going to estimate a growth rate of about 25% year on year for this company because the competition is intensifying. And in the most recent year, they're saying they can grow about 34%. And as we all know, as the company gets bigger and bigger, it's hard to grow. That's why I put 25% year on year growth. With that, they can make about $7 billion of revenue in 2027. Since they make about 75% gross margin, 25% net profit margin is reasonable. So with 25% net profit margin, they can make about $1.7 billion of net income in 2027. For a company that's growing in the 25% range and has a 25% net profit margin, a 25 multiple is fair, but I'm going to pay a premium for cybersecurity leader like CrowdStrike and assign a multiple of 27.5, with which this company would be worth about $47 billion in 2027. And we do know that this company is offering stock-based compensation significantly and diluting the shareholders. Currently, they have about 240 million outstanding shares, as I have shown a second ago. I'm going to consider 2% dilution for the next few years, with which this company will have about 260 million outstanding shares, from 240 million today to about 260 million in 2027. I think they are going to dilute us more, but I'm going to be optimistic in this case. So with that, when I divide the $47 billion of market cap with 259 million outstanding shares, I get a stock price of about $181. Currently, it's at $141, right? So that's about 28% gain, which is not at all attractive. Let me show the great execution case now. I'm going to assume an estimated growth rate of 35% year on year. Note that in the recent year, they're saying they can only grow about 35%. So assuming 35% year on year for the next 4 or 5 years is very optimistic, and that's why I'm saying that this is a great execution case. I'm going to assume a net profit margin of 30%. If they can be very disciplined with their operating expenses, they can reach 30% net profit margin. With that, they can make about $3 billion of net income in 2027. And I'm going to assign a premium multiple of 30, with which this company would be worth about $90 billion in 2027. And I'm going to keep the number of outstanding shares the same, with which this company would be worth about $348 in the great execution case. Current stock price is about $141, right? So that's about 147% gain in 5 years, which is very attractive. For my personal investing journey, I follow the valuation with reasonable assumptions case, in which I'm estimating $181 stock price in 2027. And if I want a 2x, I have to wait for this stock to get to about $90. But the problem is it may not get to $91 territory, because once the stock gets to $100, a lot of people will start to buy in. So for my personal journey, I'm going to wait until it gets to about $120 range, in which I'm at least looking at a 50% in the next 5 years and at least beat the market. And if they do a great execution, my upside will be significant. But I'm going to wait for $120 or less. Let me know your thoughts in the comments. Thank you so much for watching.